Okay, so these first two are just allocating cost. So in both cases, they give you like 2 or 3 blanks, and what these columns mean essentially. The first one, unadjusted, means that your opening balance. So what you started with, your inventory at the beginning of the fiscal period of this stuff. Inventory count means the end of the year, end of the fiscal period, what you had left. And then the expense, the last column, means how much you're expensing or how much you used up. So the column 2 and column 3, how much you expensed and how much is left, those should both equal the first column. So for example, in the first one, if you started with 300, at the end of the year, you count there's 100 left. It means that there's 200 that's been used up or been expensed. So that's why you see that's 200 in the expense. Same thing for the third one. Okay, so if you started with 1400 and you counted 650 at the end, that means you've used up 750. It's gone, no longer there. So the next one was the exact same concept. The columns were just named a bit differently, but it's just for insurance. So again, it's what the policy was worth when you bought it. Column 2 is what's left at the end of the fiscal period. And column 3, the expense, is going to be what you used up. So exactly the same math. So for this one, if you bought it for $875, you've used up $325, or that's much left, that means you've used up $550. So it's the exact same question, they just have different names in the columns because one's supplies, one's insurance. So you can check that you got those numbers. You want me to go over any particular blanks, I can, but if you know how to do it once, you can do all of them pretty much. It's the exact same thing. Okay, so that one was simple. Number 2, we're going to journalize, or actually put in T accounts, and then journalize the 4 adjusting journal entries. These same 4 adjustments are going to be what we put on the worksheet in 8.2. So if you know this here, that will be a lot easier. And we're not going to go over this again. Let's assume you know what those are going on the worksheet. So this tells you in the paragraph at the start there that your supplies balance started being $5,050. That's the opening or starting balance. And that insurance was worth $2,100 at the beginning. And then it gives you this information below. Supplies at the end of the year were $1,450. So to figure out what's been used up, you just take the difference between that number and $5,050. That's how much is gone. And then what you'll do is just transfer it from being supplies to supplies expense. So from being an asset to being an expense, because you used it up, so you don't own it anymore, it doesn't have value, it's not an asset, you still spent money on it, so it counts as an expense. So you're just taking it out of here and putting it in here. And then the ending value of supplies is $1,450, what I told you it was. Okay, insurance, same concept exactly. So moving things from being an asset to an expense as you use it up. This says that the insurance was a 12-month or 1-year policy, and you bought it on July the 1st. So that means you owned it for exactly half of this year. So you had it for the last 6 months of the year. So easy math, if you owned it for half the year, you would have used up half the insurance policy. And if it was worth $1,200 or $2,100, like it says in the question above, half of that is $1,050. So you just move $1,050 from prepaid insurance to insurance expense because it's been used, it's gone. And then the remaining value in insurance is going to be the same, $1,050. It's the other half that's left. So this exact same concept here for 1 and 2, just moving it from asset to expense. Number 3 is a late invoice. Okay, so something you did in December, the invoice comes in January, you've got to put it on December's financial statements because it's part of that fiscal period. This one's simple. It's the same as if you would have done any invoice. So you credit accounts payable, because you owe somebody money on account, and then you debit whatever you purchased. In this case, it was advertising expense. So there's no moving anything there, it's just putting it in the accounts in the first place. And the last one is moving stuff again. So this one is unearned revenue. It says a $20,000 cash advance for services you're going to perform was deposited in your accounts on December 15th. But as of year end, you've only completed 30% of the work. So that means 70% of that 20,000 is unearned revenue because you haven't done the work yet. So you can't recognize it as revenue. So what you've got to do is just move it. So 70% of 20,000 is 14,000. So 20,000 times 0.70 is 14,000. You're going to debit fees earned to remove it from the account, and then you're going to credit unearned revenue, which is the liability account. And it's going to stay there until you finish the work next fiscal period. So you're just taking that 70% out of revenue, putting it in unearned revenue, and then your revenue balance is now only 6,000. So the 30% of the work you finished. Okay, so those are your 4 adjusting journal entries. They're always the same 4. So once you do them a bunch of times, it's really simple. In the next section, the same 4 things happen, just put down in a different format. And then if you were to take these things here and put them in a journal, so the debits and credits you did, it would look like this. So these are the exact same 4 journal entries we just did. So there's supplies being moved, insurance being moved, your late arriving invoice, and then revenue being moved to unearned revenue, the last one. And the note for all of them is like to adjust the account or whatever, because it's the adjusting journal entry. And the date is the last day of the fiscal period, which in this question is December 31st. Okay, so part C, the part that required the most thought for this one, we'll go through them. So it's talking about if you didn't do those 4 adjustments you just went over, how would that affect your total assets, total liabilities, and your net income at the end of the year? So would it be overstated, there'd be too much in there, understated, not enough, or correct if you had not done this? So we look at the first one. If we had not done this, so if you hadn't removed money from supplies and put it into supplies expense, what do you think would happen to total assets? Would it be over, under, or correct? Yeah. Over, yeah, because you've removed money from an asset account here. So if you hadn't done that, you would overstate your assets. This is not going to affect liabilities. That'd be correct because there's no liability account there. And then net income. If you hadn't added this to supplies expense, would net income be over or understated? Remember, net income is revenue minus expenses. That's how you figure it out. Yeah. So net income would be actually over because you wouldn't have an expense in there. Thank you for guessing though. So if you didn't put this expense on your income statement, the expenses would be lower than they should be. So you'd be overstating your net income. The answers to part 2 are exactly the same because in both cases you're moving something from being an asset to an expense. So the over-understating situation that happens here is also going to happen here. So they're both going to be identical. Over, correct, over. Over, correct, over, because they're both exactly the same thing happening. Okay, if we look at the third one, this one is different. So this one you're increasing an account payable, you're crediting it, and you're also increasing an expense account. So there's no asset here, so that would be correct. That's not been touched at all. Your liabilities, would they be over or under if you had not done this?
Overstate.
Under, yeah, it'd be under because you've added to a liability. So if you didn't add to it, it'd be under. And then for net income, same thing. So in all 3 of these, you're debiting an expense. So if you hadn't added to the expense, you're gonna overstate your net income. So that's why this one is correct under over for that one. And the last one, unearned revenue. In this case, again, you're adding to a liability. Unearned revenue is a liability. But this time you are subtracting from your revenue. So, same as the one above. If you hadn't added to a liability account, you'd be understating your liabilities again, just like last time. Assets are correct because you haven't touched them. In this case, if you would not have subtracted money from revenue, you would overstate your net income because revenue would be too high. So that's why this one is correct under over. So knowing how to do this just helps test your knowledge of what's actually happening. So like how's the money moving around, and then what categories of accounts are going to be affected if you don't do it. And this is why you've got to do them, or else when you make your year-end financial statements, they're going to be wrong because you have not fixed your account balances. Okay, so I believe you guys got that one down. The next one is just doing, looks complicated, but it's not, because you're just filling out a inventory thing here. So this is an example of just a business counting their supplies inventory. So supplies are stationary, like envelopes, paper clips here. And then to figure out inventory, you would just multiply the quantity by the per unit price to get the total. So that's what these are. They're just this multiplied by this, and they've added them all up. So basically at the end of the year, this company's supplies balance is $995.60. That's what they ended with, that's what's left. So if you were adjusting their supplies account, it tells you they started with 2018. If you ended with $995.60, the difference is what's gone or what's been used up. So that's why they're taking $1,022.40 out and moving it to here. That's the supplies that are gone. Okay, so this is going from here to here. Rowdy Grady, thanks, story. Okay, so this next one, there's a lot of questions in this one. Simple insurance calculation. So it says you bought this insurance policy on August the 1st. So if you bought it on August the 1st, it means you used up August, September, October, November, December. So 5 months, right? So you used up 5 months, and then there'd be 7 months remaining if it's a 12-month policy at the end of the year. So to figure this one out, the expense amount for year 1 is what you used up. So it's 5/12 of the initial amount. So you go 5 divided by 12, it'll give you a decimal point, multiply that by 648. So they used up 207. And then the other part, the 7/12 is what's remaining. So that's the value in prepaid insurance as of December 31st. And then next year, in year 2, they'll use up the remaining 7/12. So that's why they're using up 7/12 here, and the balance at the end of the year is now 0. So they use up 5/12 and 7/12 over a 2-year span. And that one. Okay, this next one is really good practice. Try to be efficient going through them. There's 2 mistakes in the answer keys that are both the same mistake. So this gives you when you bought the insurance policy, and really important, the second line there is which year you're doing the adjustments for. And the key thing here is when you're making an adjustment at the end of the year, you're only adjusting for that calendar year. So you can't expense more than 12 months of an insurance policy in 1 year. Whereas the answer key has them doing like 15 months, 18 months, which is wrong. So the first one's simple because the purchase and the year end are the same year. So you bought this on October the 1st, so you would have owned it for October, November, December. So 3 months. So you would have used up 3/12, and you would have 9/12 remaining at the end of the year. And it tells you that the policy's worth $360. So this just shows that you've used up 3, there's 9 left. This column here, in all the cases, is just asking for what's the remaining value. So that's the 9/12 of 360 is 270. And then in your journal entry below, you're doing the journal entry for the amount you've used up. That's always what the adjustment is, what you've used up. So they're moving 3/12 or $90 worth from being prepaid insurance to insurance expense. So this is for the amount you've used up, 3/12. Okay, the next one is trickier because you bought this policy in year 4 there, but you're doing the adjusting journal entry for year 5. But this is a 2-year policy, so it's worth 24 months, not 12. So a couple little curveballs there. If we look at our table here, this part's correct. So at the end of year 2, you would have used up 15 months, because you would have used up 3 months in the first year, then 12 months in the second year. So 15 months have been used up, and that means there's 9 months left, because there's 24 months to begin with. So that's why it's 15 and 9. Okay, the remaining value is 9/24, because there's 9 months left, but it was 24 months to begin with. The mistake in the answer key is in here. This is correct here, but the number they put is wrong. So even though there's 15 months that have been used up, the first 3 of those would have been done in last year's adjusting journal entries. This year, you're only doing the adjustments for this year's insurance, which is 12 months max. It's only 12 months in a year. So you would have used 12/24, or half. Then half of 360 is 180, not 225. 225 is 15/24. So this number is wrong, because it should be half, or 12/24, so it should be 180, because you can't expense 15 months of something in 1 year. So that's a mistake right there. Part C, going back to one that's a little easier, but this time the trick is that year end is not December 31st, it's October 31st. So you only had this policy for 1 month. So you've used up 1, there's 11 months left, so the remaining value is 11/12. And then your journal entry is 1/12, so $38. So you're gonna expense 1/12 in that year. D, another one that's same year, so simple. You bought it on March the 1st, so you wouldn't have had it in January or February. So this time, you've used up 10 months. There's 2 months left, so the remaining value is 2/12, which is 120. And then your journal entry, your expense is gonna be 10/12, or $600. So you've expensed 10/12 of it. E, the same as part C. So you've used up 1 month of this one. So that's why, again, it's 1 and 11. 11/12 is the remaining value. And then if we look at our journal entry, it's 1/12, or $75. And then the last one, another typo in the book, just like B. Okay, so you bought this in year 4, but you're doing the adjusting entry for year 5. So you would have used up 6 months in the first year, 12 months in the second year, so 18. So they've used up 18 months, there's 6 left of the 24. So the remaining value is 6/24, or 270, and this is correct. The maximum amount you can depreciate in 1 year, 12/24, not 18. This amount should be 540, because that's 540 is 12/24. This 810, that's 18/24, it's the wrong number. So it should be 540, because that's half of 1080. So if you can do all that stuff, you're an expert. There's nothing that could possibly throw you off in the test, because there's tons of practice there. And insurance is the hardest thing to calculate. That's why there was the most practice of it in the questions, to get used to it. Okay, the last one, I know it's a lot of stuff today, but we'll go this one quick. This one had you buying an insurance policy or a prepaid license. So you would debit that account, it's an asset, credit bank. You purchased it with cash. At the end of the year, they had used up 9/12 of it. So you'd move 9/12 of 720, which is 540, into the expense account. So 9/12 get moved, and then next year they bought another insurance policy. So the same thing as the first one. You put 720 in there. Then in that year they've used up a full 12/12. So 720 gets moved into the expense account because they would have used up 3 months of the previous policy, then 9 months of the new one. So it would have been a full 12 months that you're expensing. Okay, so you guys want me to go back over any of those things?